I want to bring in someone else who has been watching all of these developments very closely. That is Jeffrey Currie. He's Global Head of Commodities Research at Goldman Sachs. Jeff, it's great to see you. A lot of moving parts here, obviously, because it's not just about Russia and Ukraine. It's about a potential Iran deal. It's about what we're seeing in global supply elsewhere. What does this calculus all equal when it comes to oil prices, in your view?
Well, you have the Russia situation as being like a right tail event, and you have Iran being a left tail event. And you watch how the market's been pricing for the last week and a half. It's swinging between these two type of events. I want to emphasize that when we look at the history of energy flows between Russia and Western Europe, they've only been substantially halted once, and that was in 1941 when Germany invaded Russia. In other words, it simply doesn't happen. It takes an extreme event. And so, given so far what we've seen, it's still relatively, the retaliation is relatively modest, which means, the likelihood of a disruption beyond, further, let's say, putting a halt on a Nord Stream 2 is probably about this stream we're going to see. Because remember, U.S. and Europe still take a substantial amount of oil. So I think, going back to, the Iranian event, so I think the offset here would be the potential to see Iranian supplies being approved through an Iranian deal. I want to emphasize a couple points on that. One, yes, there is inventory that can be brought to the market rather quickly, but that's not a substantial amount, somewhere around 50 million barrels. And just given the fact that, first time these ships are going to be used in several years, it's going to take months before you get that full amount of supply in the market. Then in terms of actual productions, you got to get the weapon inspectors into Iran to just say that they met their side of the deal. Then the oil can flow. If we use 2015 as the guideline for that, it's talking another 2 to 3 months beyond that.
Jeff, what is preventing oil prices from blowing past $100 a barrel?
Obviously, we came really close, a few cents from it yesterday. Yeah, I think the key point here is the market is very short. Inventories are very low. Spare capacity is being exhausted. The response to supply to higher prices due to a combination of ESG factors and I would say a history of poor returns, we're not seeing the supply response to higher prices. That leaves the market very vulnerable. That's why we can go up and down $5 a barrel on news about what's happening in Russia, despite the fact that it historically hasn't had that big of a disruption, or we go down $5 a barrel off the back of the Iranian noise. The market is on a fine edge right now, leaving it very volatile and very susceptible to any type of disruptions. Now, I want to emphasize, what could happen here with Russia is, the unintended consequences, an accident or, some disruption in Ukraine itself. But the market, again, is very vulnerable. So the upside potential here, because of the lack of inventory, lack of spare capacity, is very significant.
Jeff, specifically for the United States, what is the spare capacity ability? Because, private producers here could, in theory, ramp up more, couldn't they? Don't they have at least some level of capacity?
At this point right now, the rig count is relatively low. It's sitting somewhere right around 500 rigs of horizontal rigs, which is a little bit above the break even. But it's not at a very, very high level that gives them the ability to really ramp up. And part of that is this whole idea of capital discipline, that the investors don't want them to ramp up. So what does that leave you with globally? There's really only two producers today who can produce more today than they could in January of 2020, pre-COVID. And the answer to that is UAE and Saudi Arabia. Russia can't hit their OPEC quota. The United States is 1.5 million barrels per day below those pre-COVID levels, and everywhere else around the world struggles. So to answer your question, where does the spare capacity reside? It resides in the Gulf. I might throw Iraq into that calculus as well. But I think the key point is isolated to a very small group of producers, which is, again, why the market's so exposed to the upside.
Jeff, this entire situation has me thinking back to when I first started my career. I think it was 2005, and Goldman was calling for a super spike in commodities. That was something not a lot of us heard at the time. Do you think the stage is set for something similar right now?
Yeah, I mean, it's the exact same setup as what we had back then in terms of we had, very strong underlying demand. It was at that point, it was the, resurgence of China. Put that in the context. In fact, the story we were telling back then is the same one we're telling today. In fact, the term revenge of the old economy, we first published it in February 2002, 20 years ago this month. And so the story today and the story then is pretty much the exact same thing. You had the dot-com boom, taking all the capital away from the old economy. That's why we called it the revenge of the old economy back then. And then you had the strong demand coming from China. Today, what do we have? We have the same revenge of the old economy. It's the FANG boom instead of the dot-com boom, doing the exact same dynamic, sucking capital away from the old economy. And then in terms of the demand, instead of it being China-driven, it's COVID-driven with the policy stimulus off of those, the recent policy stimulus in the system.
And if one is a believer in that super spike theory, what are the best trades, Jeff, one could put on here? Do you go long oil? Do you go along aluminum? How do you set this up?
We were to say oil, copper, aluminum, all of these are the markets that are the most exposed. If I just go pure balances, aluminum is the one that's the most dislocated. Why? We call it the climate paradox. It creates emissions to produce it, plus you need it to solve climate change. And also it's very much exposed to the energy crises that you have going on in Europe and the one that took place in China. So not a lot of supply, a lot of demand. Copper is the strategically most important commodity. You can't electrify the world without copper, given the restrictions around the periodic table in chemistry. And then in terms of thinking about oil, it's still strategically, it's critical to global economic growth. And we're running out of spare capacity and inventories are low. The way I like to describe the answer to your question, metals are likely to be a better Sharpe ratio. In the end, oil will probably give you better returns, but it'll be a rocky road. I like to say, buckle your seatbelt, hang on for the ride. It's not going to be a straight line up. It's probably going to be very volatile.
Yeah, and we've gotten a little bit of a taste of that, haven't we, thus far this year. Jeff, I also wanted to ask you about the sort of inflation hedge that is inherent in some of these trades, which you talk about in your most recent note. And isn't the sort of vicious circle that you get here is that if people get into commodities as an inflation hedge, that then ends up exacerbating inflation, right, or keeping it higher for longer, and you get this sort of cycle. Is that what you expect to sort of happen, and how long could that persist?
Well, I think when we look at why commodities are a great inflation hedge is that the argument for cost push inflation really is, it doesn't make sense because it's always cost increases are what we call a relative price move. To get real outright inflation, it has to be demand pull, pulling everything along. And ultimately, it's the stimulus-driven demand that we're witnessing today that's pulling along all those goods, oil, and the rest of the cyclical commodities like copper, aluminum, and the rest of the base metals complex, because they're all getting pulled along by that same demand, those same demand drivers. People like to think about, gold or Bitcoin as being good hedges against inflation. Let me remind you, there's no gold, there's no Bitcoin in the CPI. If you want to hedge inflation, you hedge it through oil and metals and things that go into what are in the CPI.
You mean gold isn't the big component in CPI? Jeff, it's a good reminder for folks. Thank you so much for being here. Your knowledge on this stuff is just unparalleled. Jeffrey Currie, Global Head of Commodities Research at Goldman Sachs. Appreciate it.